Today's episode is part of our special series with Q2 called The Experience Factor. Over a series of episodes, I'll talk to consumer banking experts and financial institution leaders about how account holder experiences and engagement contributes to long-term success. We'll discuss practical, proven steps to differentiating and growing your financial brand. Welcome to The Experience Factor. Hello and welcome to Banking Transformed, the top podcast in retail banking. I'm your host, Jim Roos, owner and CEO of the Digital Banking Report and co-publisher of the Financial Brand. The 2025 Retail Banking Trends and Priority Report reveals an industry in transition. While 51% of institutions are actively implementing digital transformation efforts, 22% struggle with implementation or have halted their efforts. Key priorities focus on improving digital experiences at 52% and enhancing data capabilities at 33%, while AI adoption is slowly expanding beyond security into customer service and process automation. Most interestingly, despite the continued focus on improving digital delivery, organizations, especially credit unions, are still building new branches. My guest on Banking Transformed is Mark Sievewright, Chief Strategy Officer at SRM. He shares his perspective on where banks and credit unions can focus their efforts and whether some of their investments may be misguided. He also discusses how the findings challenge conventional wisdom around digital transformation and highlights the complex balance between innovation and customer expectations. The 2025 edition of the Retail Banking Trends and Priorities Report, sponsored by Q2, highlights some of the advances seen in retail banking while illustrating the gap between where the industry is headed and where it needs to be. As traditional banks face increasing pressure from fintech providers, leaders are driving a surge of technology partnerships and innovation initiatives, while laggards appear to be becoming comfortable with just business as usual. So, Mark, before we start, can you share a little bit about your background and your role at SRM?
Oh, thank you, Jim. Great to be with you, sir. I've been a longtime fan and admire your work greatly. So, Jim, I've spent 35 years in financial services. Much of that time has been in the United States. You can tell that I have just a slight accent, which hails from Wales in the United Kingdom, where I grew up. Most of the 35 years has been the United States. I was a banker originally with HSBC in London, was with MasterCard International in Brussels for several years. And then when I came to the States, Jim, I've really been around the technology and advisory space. Highlights of that were 12 years at Fiserv, where I ran the credit union business there. And also nowadays, part of Strategic Resource Management, or SRM, where I serve as the Chief Strategy Officer and also the practice lead for their strategic advisory business.
You know, it's interesting. When we look at this report and we unpack it, you mentioned technology. A lot of the report really focuses on where organizations are in their technology stack. But that's not all we have to worry about. The reality is the report shows that 52% of all financial institutions are prioritizing improving digital experience for consumers. Yet less than 25% prioritize updating legacy systems or digitizing the back office. Now, while some of that may be caused by the fact that some have maybe already done it, the reality is that's not always the case. In fact, the top priority for credit unions is updating legacy systems at 45%. What's causing this difference between credit unions and the marketplace as a whole? And how big of a problem is it when we're talking about updating back office systems?
Yeah, what a fundamental question, Jim. So it's not inertia, first of all. It's not that those credit unions are sitting there wondering, or not caring about their digital ecosystems or how effective they are. A lot of it is around investment capacity. You know that credit unions, on average, are much smaller than your average bank, and they have a disproportionate share, lack of the financial services market, 8 to 9%, even though there are 4,600 credit unions. So to some degree, it's about investment capacity. It's also about prioritization, Jim. They historically have not prioritized the replacement of legacy systems at quite the same pace as some of their competitors. But I can tell you from day-to-day experience, they're playing catch-up fast. And there's an incredible focus now on improving, where they've been heading, to your point in the introduction, to where they know they need to be. And a lot of that is around digital.
Well, it's interesting. Replacing core systems can be a 10-year initiative. The reality is there's ways now to do it where you may be doing it on a composable basis, in some cases on a sidecar basis. Yeah. But even if you're going to replace the entire legacy system, there's organizations out there that can get it done for an organization in a comparatively short amount of time, maybe 12 to 18 months, if everybody's on the same page. And one thing we found in our research was that many organizations find that it's not like you have to rebuild everything from beginning. About 80% of what's being offered in the marketplace is going to be the same from organization to organization. So if organizations can feel comfortable in focusing on the 20% that has to be done and done differently from organization to organization, it gets to be a little bit easier. It's interesting as we look at other research findings in our report, we find that 62% of financial institutions now offer some version of real-time payments,
yes,
while only 40% of credit unions offer this capability. While many of these small organizations were the first out of the blocks with real-time payments, obviously they have not kept pace as a group. What is a main barrier for preventing the wider adoption? Is it the same thing? Is it investment capabilities?
Well, it's a great point. And Jim, what's really been pleasing, before I answer your specific question, is how many financial institutions in the Q2 survey are doing both send and receive now in real-time payments. You know as well as anyone, it wasn't that long ago that most institutions were just doing receive. They weren't doing that. If that, absolutely. Yeah. So let me answer your question. It's really simple. Fear of fraud. So the fraud issue around real-time payments, Jim, is palpable. It's in every conversation I have, certainly with our credit union clients. And they're being quite skittish overall in the pace at which they allow both send and receive capabilities within real-time payments. And look, it's ironic that we're now introducing, as an industry, AI capabilities to help us control and manage. Who'd have thought, right, Jim? Given when we look back on our careers, we now have artificial intelligence as a real part of our industry today. But it's not inertia or complacency again. It's kind of like the core system question you asked. It's much more this fear of fraud and making sure they've got the right policies and controls in place before they let loose with real-time payments.
It's interesting, Mark. Speaking of AI and fraud, looking at AI applications, which we're going to probably discuss a couple more times in this discussion, fraud detection leads use cases. And that's probably because AI has been used the longest in detecting fraud and privacy and things of this nature. But content creation, it was at 25%, and chatbots were at 28%, compared to fraud detection at 33%. So all three of those are getting some traction. However, it still really isn't being implemented on an overarching basis. How do you see these priorities shifting in the next 12 to 24 months? Where do you see AI growing exponentially compared to other uses within financial institutions?
Now, a very topical question. So we know that AI has been around 50 years. And what happened in November 2022, Jim, is somebody hit the fast forward button, and it was called ChatGPT. And ever since then, we've, as an industry, been somewhat obsessed by the capabilities of AI. But here's one of the roadblocks. A lot of institutions, especially the ones that I deal with every single day on the credit union side, are still formulating their policies and their strategies towards the use of AI, including their compliance protocols. So they haven't rushed headlong into AI. They've been somewhat not skeptical, but cautious is a better word, Jim. Somewhat cautious. But along the way, ChatGPT has developed incredible competencies, not only around content creation, to your point, but now we've got Agent GPT, the latest innovation.
Yeah.
And here, now we're going to see some really interesting use cases. I'm not exaggerating. It's not my style, Jim. We are on the cusp of, in my opinion, the biggest technological revolution of our lifetimes. Because what we're going to see now in terms of AI is the ability to do something that we've never been able to do. We've never been able to humanize technology. We now have the opportunity to make technology feel human, look human, sound human, and guess what? Do jobs that humans do.
Yeah.
And there's going to be a massive efficiency opportunity for us. And I see an acceleration in financial institutions' adoption of AI across multiple use cases.
You know, it's interesting. In the research, we did a crystal ball look at what's going to happen by 2030 and what will happen later than 2030 or maybe not at all. 76% felt that most institutions will use generative AI by 2030. This seemed kind of low to me in certain ways because I know what's being done right now is when you look at generative AI, it's being done more and more in the customer care area, in the call center area, but really not being used to its best degree. And we were talking about it yesterday with a bunch of people that we were on a call together. And one of the things we found was that the whole banking industry view of risk makes it so financial institutions get real skittish when it comes to like an agent AI function where you're offering recommendations based on what you know about the customer. And we got into a discussion as to if the agent's going to actually reside within the financial institution for the benefit of the consumer, or if the consumer is going to buy an agent AI tool from a third party to build this open banking consolidation of information to recommend what I should do next. Do you have any take on which way you think it might go?
I do. And I think what we're likely to see is the adoption of AI on sort of basic fundamental levels, Jim. What I mean by that is having AI take away things that are repetitive tasks, easy to allow software to take over instead of having people do them. The call center or service center, whatever we call those, contact centers, depending on the types of institution, those are ripe for automation and change through AI. Because you know this, roughly a third of the calls we see on an inbound basis are for very routine, fundamental things, Jim, like, did my paycheck clear? What's my balance? I'd like to do this. AI can already do that. And we're going to see, I think, a real sort of progression of the maturity of AI in terms of how it's used. But it'll start with the fundamental things. And the compliance issues, as you alluded to, are significant. I think we're going to see a somewhat slow but steady adoption of AI for more complex things like financial advice that you just alluded to. You know better than anyone that we've had fintechs already use technology to launch wealth management solutions, right? We've already got those in place, Jim. They haven't captured a great deal of the market, but they've done pretty well. So we're going to see AI mature in terms of how it's adopted. And I would add one other thing. I love the survey that Q2 did, by the way. I thought it was incredibly informative. But sometimes we don't know we're using something already when we're asked if we're using it. Yeah. And my point is, I think that many financial services executives may feel that whilst they're not using AI, many of the companies that are supporting their organizations probably are. And therefore, by default, they're using AI too.
Great point. Yep.
Right.
Exactly. Yep.
Yeah.
Well, let's go from the future to what I consider just the staggering past that we keep on doing two things at once. So
Yeah.
35% of the organizations we surveyed overall plan to expand their branch network. I thought that was stunning. But when we broke out credit unions, 61% of credit unions intend to increase their branch network in 2025. How do these physical expansion plans align with the digital transformation goals of these organizations?
Yeah, what a wonderful question. I might eat my hat here, Jim, in how I answer it. So be careful. Several years ago, I made a prediction at a conference that never again in my career or the audience's careers will we see a net increase in the number of branches in the United States, right? On a net basis. And guess what? We're kind of tracking that way because even though every single day it seems we're reading about Chase or B of A or Wells, these big branch players that you've done great work on in the financial brand context, opening new branches, they're closing existing ones sometimes at a faster pace than they're opening the new ones. So on a net basis, what we're seeing, Jim, is branch optimization. We're seeing new branches being opened, but we're also seeing a real healthy dose of branches being closed. And on a net basis, the number of branches in the United States is not actually going up. At best, it's staying flat, and more likely it's coming down moderately. I look to my alma mater in the United Kingdom. The branch strategies in the United Kingdom, Jim, are all about shut down the branches fast, move to digital. We've seen a record pace of change in number of branch closes in the United Kingdom.
Yeah.
And there are now companies opening up shared locations for existing financial institutions to use for those customers who want to use them. I'm not saying the United States is going there anytime soon. I don't believe that. I think the branch is fundamental to the banking system. But I think we have to really follow the data and track how many branches are closing with how many branches are truly being opened on a net new basis.
And square footage and footprint, things of this
Yes.
nature. What's interesting, though,
Yes.
is a lot of people reference the Chases and the Bank of America as well as the world. They got to realize those are different organizations, even the Capital Ones. Chase, I know for a fact, are building branches where they don't already have them, but where they have a really strong penetration of the card business. They're just trying to expand relationships organically. And I think that makes a lot of sense for those organizations. What scares me is that smaller organizations continue to think that if they want to generate brand new relationships, that the branch is the way to go. I'm sorry, but the cost of building a branch is still astronomical, even though real estate costs have dropped a bit and all that. And I just think that we've got to think smarter rather than do some of the old things just at a faster pace. That's an area that just baffles me. I understand it, but I think that there's better ways to go about that.
You're spot on, because one of the things we're in the middle of, and again, you've covered this thoroughly in the financial brand, demographic shifts in the United States are really, really important to understand. We're all on this conveyor belt of life, right, Jim? And what we know in this country is we've got 52% of our population today that we call Gen Z or millennials.
Yeah.
They want you to have a branch near where they live or work, but they have no intention of ever coming in.
No, they like the billboard.
Unless they have to. Exactly right. It becomes an expensive billboard for them. But they use it as a safety net. And that's why, to your point, the square footage is changing. The number of people we employ to work in our branches is coming down. But also the types of people we're employing to work in our branches is changing. Jim, I started my career as a teller. I needed to know how to Did you do the same?
Yep.
I needed to know how to cash a check, how to count money fast, and how to write on an old receipt and give it to the customer.
Yep.
I needed to be really good at those things. Today, if I was back in that world, I'd have to have great empathy skills. I'd need to understand how to cross-sell or help somebody when they need it. And I'd need to be using data that was at my fingertips in order to do that. So the whole branch model is shifting in the United States. And a lot of it is to do with generational change.
That's a great point. You're right. I mean, I remember you would get fired if you didn't balance at the end of the night, even if it's by a couple of cents. So you always carried a little extra coin in your pocket just in case. And then the next day you'd end up reversing the transaction. But you wouldn't be fired for not selling. You'd get patted on the back, but you wouldn't be, reprimanded if you didn't sell. Today, that's, as you mentioned, a completely different paradigm.
Yeah.
You have people that not only are being forced to make sure they look for opportunities, but they're given the data to do so, which is really the exciting part of the whole data model nowadays, where it's composable solutions that you have all this distributed data so that, in fact, in some branches, they know as soon as you walk into the branch who you are, what your opportunities are before they've even reached a window because of the ring around the branch with regard to being able to track who that person is.
Yeah.
It's interesting.
That's a wonderful comment, Jim. And Jim, if I may, just to add something to that, I think what we're all about now when you talk about where we need to be as an industry, we're about creating immersive member or customer experiences across integrated channels. Yeah. What a concept that the channels are actually integrated. And those interactions and experiences have to be intelligent. In other words, we have to know the customer or know the member, and personalized.
Yeah.
We just can't keep offering products to customers and members that already have them with us. I mean, let's offer those products to them if they have them somewhere else.
Well, it's interesting because that's that whole AI agent thing.
Yes.
The challenge I have, and it's a editorial comment I make often in these podcasts, is that both of my primary traditional financial institutions know more about me than I'd ever imagine. The challenge is they never tell me what they know about me or even act on what they know about me. I mean, both my organizations realize I transfer funds twice a month between one organization and the other, but I got to do it by writing a check because they don't talk to each other in the way that a lot of financial institutions do. And these are not small institutions. Right. These are very big providers. Yeah. On the same hand, you look and you say, there is so much opportunity out there if you take the data you know about an individual, both internal and external. Use open banking solutions to provide a solution that the customer is going to want, in much the same way that my GPS system uses crowdsourcing to get me from point A to point B in the most efficient and effective way possible. Yeah. Consumers want that level of personalization, and they're getting it more and more from other organizations, other industries. I often talk about, taking an Uber and having them continually help me in different ways beyond that ride-sharing activity or that Amazon does on a regular basis, almost invisibly without me really knowing it until I think about what was an Amazon relationship 3 years ago versus today. It's interesting when you – go ahead.
No, Jim, you're spot on. And let me imagine this. When you and I were tellers, okay, with all that coin jangling around in our pockets so we could balance every day, imagine somebody comes up to us and says, hey, by the time 2030 comes around, this financial institution is going to have to be data-driven and AI-enabled. Yeah. How on earth would we have responded to that? We didn't even know what those terms were then, right? Yeah. But Jim, that's where we're going to be in less than 5 years.
It's interesting because you go back to when I was in banking as well, and the book everybody had on their shelves, if you were anywhere near the market area, was the one-to-one relationship with Peppers and Rogers. And the reality is, they talked about in banking, you're going to have the most personalized one-to-one relationship you could ever imagine. Yeah. Well, I'd say we're not there yet. And that book is 30 years old right now, which is scary. But the reality is we still aren't there yet. And yet we have the opportunity, and we referenced it earlier in this conversation, to use our providers to get us there. The data showed in our research that 48% of institutions overall rely on core providers for about 75% of their solutions, and 38% prefer third-party providers. Now, that makes sense to me. Alternatively, though, credit unions and community banks are much more likely to turn to third-party providers as opposed to using traditional core providers. What do you think is driving this split in technology strategies?
Yeah, well, another great question. And by the way, walking down memory lane, Martha Rogers and I spent quite some time together several years ago. She was wonderful. And that book was a staple for us marketers. So I think these are the drivers. First of all, there's a realization that, again, investment capacity and prioritization is different for some institutions. And so they haven't been as focused on some of those things perhaps as others. The other thing, though, I think it comes back to a point you made earlier, Jim. The core system isn't as core as it used to be. And what I mean by that is that the core system today versus what it was even a decade ago is very different. It has to do its job. Of course, it to some degree is the record keeper, the heartbeat of a financial institution. But what we wrap around the core has become much more important. The applications, the services, the solutions. And to your question, the propensity to use third parties more for those things, I think has been one of the sea changes of the last 5 years. The evolution of APIs, Jim, SDKs, right? Software development kits.
Yep.
The evolution of these techniques and tools has really encouraged small and large financial institutions to say, look, we're going to rely more on third parties. And guess what? We're going to diversify the number of parties we actually do business with. You know what we end up with? Mullet banking. I'm safe in using this expression with you, my friend. Mullet banking. We look great from the front. Just like a mullet hairstyle. We really do. Our websites, our branches, our digital, our online apps, everything looks great. Take a look behind. Take a look from the back where the mullet's got a bit of a party going on in that hairstyle, as you know. That's our back office environment. Yeah. We have multiple systems trying to interact with each other, and we're adding on more of them every day. I think this is one of the great challenges of our lifetime, Jim, is how do we integrate all of those disparate systems in a way that they remove friction and give us good operating efficiency? And I do think AI is going to have a role to play in all of that.
You know, that's interesting. You use that analogy, which I find to be very humoring, is that it gets back to our conversation earlier around updating your core and digitizing everything in the back office. You can make it look really good because these third-party providers do well working with each other. I mean, that's part of their strategy compared to the legacy core organizations that sometimes fight those relationships. But the reality is, organizations like Q2 work really hard at making sure that all their partner organizations can integrate with each other seamlessly in the back office, which pacifies us in a way to saying, well, maybe we don't have to fix what we have in the back office, but you can't continually put a chicken wire and duct tape and make it all work together. You've got to pay attention no matter who your partners are. It's interesting because when you look at the partners too, we saw in our research that one of the ways that their organizations are using partners most is to improve their digital account opening experience, their front doors, I call it. Yeah. What's interesting is those are in demand because they are the front-facing component at the beginning of a relationship.
Yeah.
On the other hand, when you talk about organic growth, in 2030, and by 2030, 80% of organizations believe that AI will drive personalized marketing and communication. But only 32% expected significant VR or AR adoption or were really investing in the data and analytics needed.
Yes.
So what are we going to do when we talk about the fact that we believe and we've committed to personalized marketing, use of AI for personalized marketing, when a lot of our efforts on AI right now is on an efficiency level, trying to make it so we can squeeze more out of the turnip. How do we put the emphasis more back to what we're saying and have our walk follow our talk, or our talk follow our walk, I should say?
Well, I think first of all, it has to be a mindset inside the organization to do just what you've described. But that's first and foremost. It's about culture and commitment to it. The second thing, and this is my hope, is that the efficiencies that we're driving, Jim, as you've just described through the initial uses of AI, will actually be reinvested. Jamie Dimon says every expense at Chase is an investment, right? You heard that the other day. It's not an expense, it's an investment. So if my expenses are going up, it means we're investing in our future. It was actually a pretty good line.
Yeah.
We need to take these efficiency savings and reinvest them in the business towards customer and member-facing opportunities, including data and personalization. But there's also a bigger job to do, in my opinion at least. We've got to stage the financial institution to get ready for this. A lot of institutions do not have a data strategy. A lot of them don't have their data in a place where it can be accessed readily. And so no matter how much AI we apply to that, Jim, it's not going to do much good if we don't have our fundamentals in place around data. Remember when chip came to America, chip card technology, and it had already been in Europe for over a decade? The issue there was around adoption is we hadn't staged the payment system environment to be ready for chip. And it was only when the fraud started to hit, because fraud always goes to the point of least resistance, and that became the United States for a while, chip was suddenly prepped. It was staged, it was launched, and it was rolled out impressively quickly. I see the same principle and sequencing for AI. I think we're going to take care of some fundamental things first. Yes, automation, all those things that seem quite rudimentary. But then again, we're going to hit the fast forward button and move AI into personalized marketing and member and customer service. I really see that, Jim. I hope I'm right, because
that you took the words right out of my mouth. I hope you're right. Yeah, because we make these aspirational goals. We can see what the future can become, but I think what's frightening and exciting at the same time is you look at how fast the technology is evolving in a way that helps us do everything better, easier, and actually more effectively. You look at Sora from ChatGPT that can take words and turn them into videos. Things are happening at a pace where you go, I didn't see that coming. I kind of in the distance did, but it happened 2 months ago. And you go, and you start getting all wrapped up in ChatGPT, and it's hard to believe that it has only been around since November of 2022. So it's slightly more than 2 years ago. Yeah. And it involves everything we do right now. So, if you're looking at, go ahead.
It's incredible. And Jim, I used to say to folks, if you want to see the future of our industry, leave the country. And what I meant by that,
or leave the industry. Yeah,
exactly. I was saying, look at the developments elsewhere around the world that are going to come to America. Yeah. You've touched on open banking a couple of times today during our conversation. Open banking's been a reality in Europe now for several years, in Australia, in Canada, closer to home. We've got the movies to watch around open banking to find out how it ends, right, Jim? And I think, look, we're in the midst of an administration change, and who knows what the future of the CFPB will look like and its mandate on open banking. But I believe that in some form or another, open banking is going to survive.
It's interesting. We were talking about the future of banking yesterday with some friends, and I said about open banking, it doesn't matter what the CFPB says or what regulators say. The reality is we as consumers are doing it daily.
Yeah. You're doing it with your two financial institutions every month.
Exactly. We're building it within ourselves. So, it's interesting because I ask financial institutions when I'm speaking to a big group of 200 people, I ask, how many of you have closed a primary financial relationship in the last 5 years? And you'll get a couple hands go up. But the reality is part of that is because these are bankers, so they're kind of like stuck with their own organizations. But then I ask, how many of you have opened a non-traditional financial relationship in the last 2 years? And almost everybody raises their hands. And the reason I do that is to have them look around and realize that while you think you have loyalty, you have consistency, you can rely on certain customers, in reality, these relationships are being decomposed on a daily basis to the point where you don't even know attrition's happening. Yeah. My two primary financial institutions are not the key drivers of my retail account or my business account. On the retail side, I would tend to say I have higher levels of engagement with SoFi and with my Acorns account than I do with my traditional bank. On the business side, I've always said this, I have a much deeper relationship with PayPal, who processes my payments and my outflows on a regular basis, while my traditional financial institution really doesn't understand a thing about my business because it's all secondhand knowledge.
Yeah.
We see that financial institutions understand they're being impacted by big tech and fintech, but in our research, only 31% of retail banking executives thought they're being impacted tremendously by big tech and fintech. That, I believe, is so underestimated,
I do too.
and that putting the cover over your head or putting your head in the sand, whichever saying you want to use, is the most challenging or threatening aspect of banking today. Is that we aren't aware of what's happening behind the scenes because we don't look at, on a regular basis, flow of funds.
That's right.
How much would have been known if we followed the COVID checks to find out what happened to those once they were cashed, where flows of funds happened? You'd know where customers were doing and what they were really focused on. Were they trying to simply increase savings, or are they paying their mortgage payment with it?
Jim, to your point, Yogi Berra used to say, you can observe a lot just by watching. It was a wonderful quote, right?
Yeah.
When we look at our ACH files or our credit and debit card files for our customers or members, you can observe a lot just by watching in terms of where their other relationships are and where the money, as you said, is flowing. Yeah. We've got to act on that. That's pretty easy information to access.
Oh, it is, and to act on. I mean, the problem is we tend to measure what we've always measured in the way we've always measured it. Do we really know what it costs us to generate a new account and what that lifetime value is? Chris Nickel, just a good friend of mine, just wrote a tremendous article on LinkedIn around the mismanagement of reporting that we look at. We looked at traditional trends such as, what's our income, outflows, what's our balance sheet look like. There's a whole lot more important information to gather right now that you can easily measure. And certainly based on the fact that we have it all digitized right now and most people transact digitally, it's very accessible. So as we wrap up the discussion on the report for right now, what do you see as the biggest challenge in financial services today?
Moving from where we are to where we need to be. Because, Jim, the environment is so challenging that where we're trying to get to is a future state where we have immersive customer experiences through integrated channels, where we have highly personalized, intelligent marketing, where we have an ecosystem that's effective and efficient. We've got to have those things in place. In order to get there, we truly have to have, as we said earlier, a data-enabled or data-driven, AI-enabled financial institution. Getting from where we are to that point is incredibly challenging. And I think the biggest challenge we have is possibly how do we prioritize and define where we're going to place our IT investments, our resources, both people and money, in order to get to that future state. And look, we're realistic enough to know, because we've sat in those seats, Jim, you've got to go get your deposits, you've got to make your loans, right? We're in the business of buying and selling money and moving it. That's what financial institutions do. And that environment's incredibly tough right now. But notwithstanding that, I think the biggest challenge is making it a priority to move to this new future state that we have to get to. We have to.
It's interesting because you said it earlier. You can't do that without defining where you need to go or what you need to get to. I can say, I'm from Ohio, and at the southern part of the state, Interstate 71 and 75 are basically the same. Yeah. At the top of the state, they're 2 hours apart. One part in Toledo, the other part is in Cleveland. And the reality is, if you don't know where you're going, you won't know till you got to the destination that you're not where you wanted to be. And I think, I may be oversimplified in something that's not easy to change. This is a leadership issue.
Yes.
We we tend to have a lot of leaders, especially in the mid-market organizations, that they've had so much success. They have not had a down year. They've not gone broke. They're still in business. And yet they continue to do what's worked in the past. And that's not going to work in the future. And we talked about it before we got on the air, that the longer you continue to think you're okay, the further behind the marketplace you're going to be. And as I'm coined often when I speak, and I say it every time, change has never happened this fast. It's never going to happen this slowly again, which means catching up is going to be a bear.
Well said.
So,
it really is.
On the other hand, Mark, what do you think is and I think I know where you're going to go, but we'll see. What do you think is the biggest opportunity in banking today?
I think to improve how we actually conduct the business. We have an opportunity now, thanks to technology, Jim, where we can redefine the business model of banking. We really can. We can serve customers or members in a different way than we've ever been able to do. We can automate things in ways we've never been able to do. We can change the jobs of our people in ways we've never been able to do. We shouldn't have people anymore who aren't spending their time on valuable member or customer impact roles. If we have people who are doing repetitive tasks day after day after day, we're doing something wrong.
Yep.
So I do think the biggest strategic opportunity for us is to redefine how banking actually gets done. And I think that's tremendously exciting.
I'm going to add to that with something you said earlier. Look outside of your organization. Look outside of the industry and look outside of this country. There are amazing things being done in China, in India, in the UK, in various pockets across the globe, in South America and Africa, which, 8 years ago, you probably wouldn't have used them as an aspirational goal. But look at Nubank. Look what these organizations are doing and how they're doing it and how they define where they need to go. Because they're growing a whole lot faster than any organization I know in the United States. And the reality is, even if you have to look at Chase to say, strategically, what are they saying and what are they doing? You aren't going to be able to do it to the same scope. But you can't continue to do business the way you've done it and expect the results you've been receiving. Now, unfortunately, I've probably said that for more than a decade. And we haven't had the sky is falling. The reality is, the consumer now, ever since COVID, has been demanding more.
Yes.
And we've got to realize that as a consumer gets more and more used to what can be done, they're not going to do business with those organizations that don't do it in that way. I mean, it used to be a situation where I got really frustrated at restaurants that didn't take my mobile app as a payment tool. Right. Now it's very hard for me to go to a restaurant that doesn't offer that. In fact, as I've said on this podcast often, I don't take credit cards or cash to any place I go. And if they can't do my transaction electronically, I won't go there, mainly because there's risk assignment to me. Because I know my mobile app is going to look at my face, going to know where I am, going to be able to put these things all together, while plastic and cash can't do that.
You bet.
This report is great. Talking with you, first time on the podcast, has been phenomenal. And I really encourage everybody to download the 2025 Retail Banking Trends and Priorities Report, which is due to come out any day now, and take a look at all the different things we talk about, but then look at how we take that deeper and saying, what does it mean? What do you need to do? Because we talk a good game, but as an industry, we often leave it at that, and we don't really implement against the capabilities we have. We have more data, as you said, Mark, more data available than ever before, but data is simply a piece of paper unless you use it.
Yeah, well
Mark,
said.
Thank you so much for being on the show. I really appreciate it.
Thank you, Jim. It's been an absolute privilege, and thank you for including me.
Thanks for listening to Banking Transformed, the winner of 3 international awards for podcast excellence. If you enjoy our work, please give us a positive review. Finally, check out the recent articles we're doing for the Financial Brand and the great research we're doing for the Digital Banking Report. This has been a production of Evergreen Podcast. A special thank you to our producer, Leah Hassage, audio engineer, Chris Fafalias, and video producer, Will Pritz. I'm your host, Jim Roos. Until next time, remember, it's impossible to build an exceptional customer experience without a modern digital core technology.